Hey, my name is Darius, and welcome back to Founders Unchained, the show where we sit down with builders, startups, innovators, founders, and investors. The show where we discuss what it takes to build a startup from scratch, what it takes to scale the business, and even what it takes to invest into the business. And today we have a special guest, Sarah. So thank you very much for joining this episode. I know that you are from Geek Ventures. So for the people who don't know you, can you just introduce yourself? Tell us a bit about your background, who you are, what your business does, and also what is the most important, how you can help startups.
Yeah, absolutely. It's great to be here. So, I'm Sarah. I'm on the investment team here at Geek Ventures. I focus on sourcing, evaluating, and closing potential investment opportunities. I also work with our portfolio companies after we invest. And I think one of the great value adds that we provide is that we can help with like customer introductions, talent introductions, and also investor introductions. We have a really large network of other investors. We do that through our newsletter. We also do direct interest. We are a part of many deal sharing groups. So I think this is a really great value add. Also, we do portfolio support calls. So we'll actually meet with, internally with our team to figure out how we can help. And then we also do individual calls with our portfolio founders to work on their specific needs. In terms of my background, so I've done a lot of different things in my career. I've worked for several startups, on both the like operations and the fundraising side. I've been on the VC side, so I've worked for industry agnostic and industry specific VC firms, kind of both on like the sourcing startups as well as extensive portfolio support, a little bit on the operations and some social media. And then I guess I also worked in corporate, so single family residential real estate. I was analyzing properties and figuring out how to decrease expenses. The fact that I worked across startups, venture capital, and real estate, I think brings such great value to the founders I work with because I've, had a lot of different experiences. And then throughout that path, I've also worked on building my personal brand on LinkedIn. And so I have that builder mindset, and I think that's really helped me connect with founders.
Okay, Sarah, so it looks like very impressive experience what you have. Can you remember when your career started actually, the first initial job when you were starting and working for venture capitals?
Yeah, absolutely. So I think back to my first ever, like, I guess, startup and VC experience. That was back when I was in university. And it's hard to pinpoint what my, I guess, first official experience was because I had many different ones. But I think one early experience I had was participating in a group called, I guess it was an event called Blackstone Launchpad Startup Weekend. And that was actually back when I was a freshman. This was before the pandemic. I had the opportunity to go to Los Angeles and actually work with other students on a business idea. And then from there, I went on to have several different like startup and VC roles. And I think one notable experience that I had when I was working for a VC firm, like you asked, was when I had the opportunity to actually manage an MBA fellowship program. So I was actually recruiting students from top universities and, helping place them in our portfolio companies, as well as working directly with our firm. And so, in that role, I had a lot of just leadership opportunities to actually just get to help, be the right hand person to the person running this program. So I think that was a really great experience. But then also getting to listen in on founder calls, understand how investments work, and, just work on overall operations. And then, later down the line, of course, did some more sourcing experiences and working more with our founders. So I think just like those early experiences really paved the way for the work that I'm doing now.
What is the reason why you're stating that? What excites you actually to work in that field?
Yeah, absolutely. So I think for me, growing up, I've always felt like I was like underestimated and always just very different than my peers. And so that kind of made me interested in venture capital. So more specifically, like I remember one time when I was younger, when I was in kindergarten, and I did my homework twice just for fun because I thought it was just really, really fun to learn and to try to improve. And I wasn't trying to like impress anyone. I just genuinely enjoyed it. And growing up, I was always like wanting to study, not wanting to do what everyone else was doing. I was very stubborn, very strong-willed, which was really good thing for me, I think, just, as I grew up. And I think back to early experiences like why venture specifically is I grew up watching Shark Tank. I love the idea of, backing founders at the earliest stages when, they needed someone to believe in them. A lot of people were saying it's crazy, but they knew it was really good. And so I think just the fact that I could, be in that position, I was like, I know that I want to be a shark someday. And so I just even had a dream one time about being a shark. I was like, this would be really cool. But I think just that idea of getting to work with founders and support them and be that early believer, similar to how I had a lot of people that were early believers in me. So I just got really excited about that idea. And so I did whatever I could to, have that as a career.
I'm also connected with many startups and also I'm having many conversations with venture capitals. The thing what I really like is that I can be very close to the early innovators who is trying to build something new. And I'm having a chance actually to speak with people who are building something new, completely new. And this is what I really like, just to touch the new ideas, to see the new ideas and be always on the loop, with the market. So this is what I really enjoy about this thing. And I really wish you that one day you will become a shark and maybe we can see you on the TV shows someday.
That would definitely be very fun.
I really would like to understand a little bit more about the Geek Ventures. I was, looking for more information about you guys, what you do, and I noticed that you are investing in immigrant founders. So can you just tell us a bit about Geek Ventures, what kind of founders specifically you fund, and what kind of projects you're looking for?
Yeah, absolutely. And I'll start by telling the story, behind Geek Ventures and why we invest in immigrant founders. So, our founder and managing partner, he was an immigrant to the US from Belarus. He wanted to create opportunities for immigrants like himself. He was an early angel investor in 6 unicorns at pre-seed and seed, including like Instacart, and he also worked at Google and Meta and a Series A AI infrastructure startup. Ultimately, he wanted to back really amazing immigrant founders. And so that was kind of the founding story. So we were founded in 2021. I ended up joining the team, in September of 2024. So in terms of like how we invest, so we invest, like I said, in immigrant founders, specifically to the US. So we define this as founders that were born outside of the US and then moved to the US. We do reserve 10 to 15% of capital for exceptional founders that don't meet that specific criteria. We typically write 100 to 700K checks, and that's going to be at pre-seed and seed. One common question we get asked is, does that check size change based on the stage? And we say no, it's just a range based on like ownership. We want to make sure that we get the right amount for portfolio construction. In terms of like industry, we're focusing on AI and robotics. That's an area that we've become really excited about. We've kind of been monitoring the market, and we think there's really strong potential there. Specifically, like if it's the intersection of AI and robotics and not just one of those, that's even more exciting. And it's more broad, like, if I'd say it could be infrastructure layer, application layer, if it's just on the AI side, but on the robotics side, we're specifically more focused on B2B. And we typically follow. So if it's a priced round, we follow. If it's a safe round, we either can kickstart the round or we can follow, but we don't lead. And, in terms of traction, that's something we get asked often about too, is, we don't have specific revenue targets, but we do expect that founders will have like a reasonable valuation if they're a little bit earlier. So I know that was a lot of information, but I'll kind of pause there and see what follow-up questions you have.
In terms of lead, you was mentioning that you are not leading. Can you just explain to the audience who will be watching this, what actually means this lead investor and not leading investor, just for the people to understand?
Yeah, that's a great question. I'd love to dive deeper into that. So, lead investor typically means the largest investor in a round, and it's typically an investor that sets the terms. So, in a priced round, you actually will have a lead investor who will come in and price the round and sign like a formal term sheet. And then once that is set in place, then you'll typically have followers like, firms like us who will come in and say, okay, the terms are set, there's a lead that's signed. So now we know exactly, I guess, what the expectation is for the overall opportunity. And if it's a safe round, then sometimes there's a lead, sometimes there isn't. With the safe round, it's, the way it works is it's easier to close quicker. So like there's not specific, like you don't negotiate terms. So like if it's a term, like if it's a price round, you're like, okay, we have these liquidation preferences, we have like, what's the dilution protection? Like there's all these complicated terms, but a safe round is typically done on a YC safe, and it's a lot easier to close the round faster. So that's why a lot of founders and investors like safe rounds. And when we say like kickstart, what we mean, at least for us, is we mean we can be the first check. So if we're like, okay, we want to be the first check in the round, but that doesn't mean that we're going to be the lead investor. And the difference there is that kickstart means first check. Lead investor typically means largest check. Another way to think about it is the lead investor is typically doing the most amount of diligence in the round. And so oftentimes they're the ones that are maybe bringing in followers to help close out the round. They're the ones that are getting the most amount of information. Then if followers have questions, they might go and ask the lead investor to share their additional diligence. So that's the difference. And it's very important for founders to know this distinction, because oftentimes like followers like us typically require a lead. So like if there's a priced round, we would actually require there to be a lead before we can come in, because we need to know what the terms are. So as a founder, I definitely would encourage, you to actually ask the VCs that you're meeting with and say, are you a lead or are you a follower? And this is also something that we respect, because if a founder asks us very like detailed questions, it means that they're very interested and it means that they've done their research.
Thank you for this explanation. It's really important. So I really would like to understand also, can, for example, you help also with your network of co-investors, let's say, because I know some of the venture capitals, we use the network, what we have, and we share the deal across. And this is how collectively, startups can raise more capital even. So can you also help with that?
One thing that I'm really proud to share is that I still love to help founders that we don't invest in. So in one case, I actually sent over 17 double opt-in warm introductions to a company that we didn't invest in. And, this promotes such goodwill in the ecosystem. We don't do this like to make money. We don't like carry or whatever, like just from doing this, but like this is a way because we genuinely want to help founders. And so this founder, just for context, the reason it wasn't a fit was they were actually too late in the sense that they were doing really well and we just didn't invest at that stage, but we loved what they were doing. And so I said, okay, I can introduce you to other founders. These founders said yes. I made the intros, and now they've sent us additional deals that are a really good fit for us. We've stayed in touch, and I think it's just a really important thing to do because as a founder, like if you make a really good impression on a VC, the VC will remember you and find a way to help you. Like, we obviously can't make intros for every founder we don't invest in, but if there are founders that stand out, we will do everything in our power to help them because VC is really interesting in the sense that it's very relationship and network driven. All the VCs know each other. We all talk, similar to how founders talk, and they all know each other. We remember you, and this is also why I tell founders, like, even if you're talking to a VC and it's not a fit, make a really good impression because someone's going to remember you if you do your goodwill. It's kind of similar to how, like, early in my venture career, I remember a lot of times I was applying to roles and it wasn't a fit, but I made a good impression and people remembered me. And then they would like pass along my resume to more people. And then eventually I found a role because I was being like overall like optimistic and being a really good person throughout those interviews. So I encourage founders to have the same mindset.
Yeah, and this global world is actually very, very small. In capital markets, you can meet many people who know each other. So, for example, some of the guys were going to the conferences, to some global events, and this is how we meet each other, or maybe we did some co-investments in the past. And those people know each other. So I really agree with you that sometimes, it's worth actually to build this relationship, even with the people who not necessarily investing in you, but maybe we can help you out. And I'm super happy to hear that you have this mindset that, you are going to help startups, even if you are not investing, but, still have this really good and valuable mindset. As a founders, as a startups, we need it. We need this kind of help. You was mentioning AI and robotics.
Yes.
So is it only those industries where you invest, or it might be something else?
Great question. So, those are the areas that we focus on. We can consider areas outside of those focus areas, but it depends on the context. So, I guess what I mean by this is like we just don't do consumer products, we don't do medical devices, we don't do cryptocurrency, and nothing that's like regulated. But if it's like a company that is fits into AI in some way, but is not directly related to what I shared, it could be a fit. So, like, we're very open just as long as the company doesn't fall into one of our areas that we avoid.
AI also attached to the data centers, let's say, because it needs to get some data management solutions and also energy itself. So do you consider like energy projects or let's say data centers as a potential investment opportunity because it relates to AI?
Yeah, so potentially. It depends on the full like investment context, but we actually were kind of speaking recently about how there think there's like a lot of opportunities in the energy space. So definitely something that we could consider. I think for us, like we're very open to different opportunities. One thing I think that I'll share, for those listening and also for those that are like, hey, maybe I do want to, pitch Geek Ventures or just thinking about pitching a VC firm in general is we're more founder focused. So like as opposed to thesis driven, I think for us it's like we really want to back a strong founder because we know that founders are going to pivot, right? And so what we look for is we say founders that know how to sell. So founders that like, really they know how to sell to customers, maybe sell to investors, essentially like they know how to read the room. Founders that are like have really strong domain expertise in the sense that they've been building in this industry before. And then the other thing is they have a strong why now. So we want to know exactly like why are you building this and why couldn't this have been done 5 years ago? Because oftentimes we'll see ideas that we're like, maybe these are great ideas, but we've seen this a long time ago and so we're not really that excited about. So that's kind of more of how we think about it is it's more of a can we get excited about the founder, and of course the idea should be strong as well, but I think having a strong founder is paramount to the success of a company.
What are the most common mistakes you can see founders make most of the time?
Yeah, that's a great question. So let's dive deeper on this. So, are you saying mistakes founders make when meeting investors at events, when doing initial outreach, doing pitch calls, the final closing process, like which part? Because there's a lot of mistakes and I can definitely talk about them. I'd love to know like which part of the process.
Let's take this, reaching out to venture capitals, because I think this is important for the people who will be watching this episode. Majority of them are basically people who are starting the business, or we are just basically in proceeds round and we're still raising capital. So I think for those would be interesting to understand what mistakes we should avoid before we go to the investors, or maybe we need to prepare and do something before we go.
I guess what another follow up to that is when you say reaching out, are you saying like reaching out online typically? Would that be the main mode of outreach?
There are many ways how to outreach. You can find people who know somebody in the market who can do the warm introductions to you, or maybe we can, actually perform massive campaigns like cold outreach campaigns. But, for me, it's like the problem what startup founders does. We are not prepared very well. Maybe we are reaching out to wrong investors. Let's say we didn't do their own due diligence on the investors.
Glad that you mentioned this because this brings up another point. I'll actually start with this, like when asking for warm introduction, because let's talk about both cold outbound, or sorry, like cold outreach and warm intros. So one of the biggest mistakes founders make when asking for warm introductions is they'll reach out to a connection that they know and say, hey, like, I'd like you to introduce me to 5 investors that you think would be a fit. This is good. I mean, in a sense, because you're being respectful and you're just saying, hey, like, I want 5 investors. But the mistake here is that you're not being specific enough because you're putting the burden on the connector. You're asking the connector to find people that they think are a fit for you. And just for context, like, I'm more than happy to find investors that are a fit, like just generally speaking, but this is assuming that you don't know this person very well. So, like, let's say it's someone you just randomly found that you're asking for a warm intro to and they have no context. You just reach out and say, hey, I want like 5 warm intros. What you can do to make it better is you can say, hey, I saw that you're connected to these 5 investors. Here are their names. Here's why I think they're a fit. Here's a personalized blurb about us that I would like for you to send to each of these people. Can you do this? I love this. I'm very busy and I want to help, but I need specifics. So this is a great way to improve that. Another thing is this is kind of in the middle of warm intros and cold outbound, but when a founder reaches out to me cold and they pitch me and then I say it's not a fit, then they say, can you share this deal with other investors you know? The issue here is that, I've passed on you and it's already cold. It's hard for me to make the warm intro because one, I didn't speak with you. Like, I of course want to help, but
Yeah.
I think it's important that the founder is very specific. Once again, it goes back to like reaching out to, because a lot of times when the founders will reach out to me cold and I send a pass mail and they ask for an intro, they haven't done their research initially. And it's hard for me to want to do an intro because they pitched us without doing research and it's completely out of scope. And so that's why it's like hard, because like I want to help, but if you didn't do your research on me, then it's hard for me to help in return. You know what I'm saying? So
Yep.
what I would say is, and this goes back to cold outbound, when when founders are reaching out to me, is the biggest mistakes I see is the founders do not go to our website. So our website, we are very clear on how we invest. We have a how we invest page. I encourage all founders to go to the VCs that they're reaching out to and look for this. This is not always present. So if the VC doesn't have the criteria, then that's on them if they get founders that are not a fit. But we have the criteria on our website, and founders will reach out still despite it not being a fit. And so I think like now if they just reach out and say, okay, here's what we're doing. Could you consider this? I saw on your website, this is how you invest. I really like that. But if you just reach out to me and you pitch me without doing your research, that's an issue, not personalized. I have a lot of founders that will reach out and just make it general. I've had founders say the wrong name where it's very clearly a copy paste, where they're just like spamming you. Founders that just keep messaging you very often to just get a response. Of course, if I don't respond, please follow up, but don't like send a lot of like follow-ups, because then it can feel like you're, spamming. And I think the other thing too is just in the initial outreach message, not very clear on why you're reaching out. So I've had founders say, hi, sir. This actually has happened. Hi, sir. We're building a company in the brick and mortar space. We have great revenue and great customers, and we're looking to raise some money, and we think this is a great idea. Can you hop on a call? Like, this is like an actual message generally speaking, I've received. there's no specifics on like why we should be interested. So like the founders really need to say like what they're building, why it matters, what the traction is, what the terms are, and then include a link to like a scheduling link, because then it's like really easy to just book some time. So those are some of the like top mistakes I would say like I've seen across both warm intros and cold outreach. And what I'll say is like we respond to cold outreach. Like if I get a really good cold outreach message, I will 100% take a call with the founders. But founders don't realize is if they just spend like an extra 10 to 20% of time, there's a really high likelihood they'll actually get on a call with the investor. But many founders just think, okay, let me reach out to like 100 investors and just, general message. But it's quality over quantity, because the messages that have personalized information, I've actually taken those calls cold. And that may shock many founders because they think VCs don't respond, but I do read my LinkedIn messages.
Okay, thank you. Thank you for sharing this. In your opinion, what might be one underrated skill of good founder?
I've thought about this a lot. I think an underrated skill is a founder that takes feedback very well. I think this is really important because founders that are, really receptive to feedback from their investors, from their customers, I think that can position them really well, for the long-term health of their company. But I want to be very clear here is that's just a base level answer saying, okay, like we like founders that can take feedback. What's even better, and I think that's more on the underrated side and diving a little deeper into this, is founders that know what feedback to take and what feedback to implement and actually understand of like what's considered noise versus actually useful feedback. So what I mean by this is when you're a founder, you're going to be receiving so much feedback. When you're beta testing your product, you're going to have a lot of people saying, okay, this doesn't work. This needs to be fixed. You're going to be reaching out to investors, and investors will be saying, this looks bad in your pitch deck. We want you to include this. And there's going to be conflicting opinions because VCs like to see different things. What I would say is like a founder that knows how to really identify what's considered like actually like helpful feedback and really say, okay, this is something I want to do, versus knowing when to push back and knowing when to disagree respectfully, I think is very valuable and very hard to do very well. And this is actually a skill that I think even for VCs, that is a really good skill, is like knowing when to stand their ground versus when to push a deal. And this is a skill that I'm definitely working on too, is I push deals and I close deals. I remember there's this one founder in our portfolio like that does an excellent job of just listening to feedback, but then pushing back. Like when you can just talk to someone as if they're your peer and they talk to you that way, it makes it feel very casual and very effective. And so I encourage founders to really think about working on the skill, and the skill is important too because it comes not just to like after as a VC we've invested in a founder, but it actually comes into play when we're doing diligence, and maybe even when we pass on a company. I've had founders that ask me for feedback and I give them feedback, but then they push back trying to convince me to change my mind to invest even after we've already passed, and that's not the right approach. And so that's where knowing when to take feedback well and how to use it, that's an important skill. One company we invested in, I said, hey, this is not a fit for us because of X, Y, and Z. And the founder said, thank you for the feedback. We've actually heard this feedback from multiple investors and we've identified it as an issue. They took the feedback, did exactly what we said, and then we invested later in a later round because, they took that feedback well. So I think that's like the difference between when to take feedback versus when to push back. And it's a fine line between those two. And it's something that I think founders should definitely work on and is a very underrated skill.
Yeah, thank you. I know that you are investing in pre-seed and seed companies. In seed, sometimes you can find companies who actually, have traction in terms of, users, revenues, and so on. What traction means to you specifically for your venture capital?
Yeah. So this is a good question because every single investor will give you a different answer. So for us specifically, I know I mentioned earlier, like we don't have specific revenue targets. I mean, diving a little bit deeper, like we don't say you have to have X amount of revenue for us to invest. But in terms of a range, like we've invested anywhere from pre-revenue all the way up to 1.5 million in ARR. So that's more from a revenue standpoint. But in terms of like your question, traction, what we look for. So, we look for, of course, every opportunity is different, but like, if the company's on the earlier side, what we would look for is we say we want a founder that has a really strong, maybe it's like an MVP, depending on the industry, like we have invested early, maybe it's strong MVP. They have some design partners. They have some positive customer feedback. If it's on the later side, we want to see some traction, recurring revenues, evidence that there's product market fit, or at least early evidence, right? Like I said, it depends kind of on the stage they're at. But the most important thing is that there's a clear path to scalability and long-term revenue and a long-term moat. So like we want to see that demonstrated through these early traction points, but it looks different for every industry. We don't do med tech, but for like, VCs that invest in med tech or maybe drug discovery, like what traction looks like for them is going to be very different. It could just be, and I honestly don't know because I'm not familiar with that space, but like they're not going to see revenues till much later in the development process. So they're going to like what they consider traction is going to be completely different than like what we say. We're in AI and robotics, like we want to see some early revenues, but yeah, like that's what I would say is like it really depends, and it's important for founders to one, do the research on the website and see if the VC actually says, hey, like this is our specific revenue, whereas other VCs might say, hey, like we're pretty open. It just, can we get excited about the overall opportunity, the founders, the market, etc.
I really value your advice. For the founders who will be watching this, I think it's important to highlight again that, it's important to do the homework before you go to anybody to speak. And most of the very important data you can find in websites, actually. If you will spend some time, you can always find many, many information, which will be very valuable to you. So by doing this, you can save your time or you can be better prepared for the call with investor, and you will show that you actually did some research before you came to them, and that's going to be very beneficial to you. What signals instantly increase your confidence in a founder when you see one?
Yeah, so I love this question because I think this is a lot of founders are like, hey, like what can I do to get to that investment? So I look at it from the first impression that I've had with the founder. So this goes back to when I first meet the founder. So this could be at an event, it could be through, LinkedIn DM, it could be through a warm introduction. And I think ultimately it goes back to like, because a lot of it comes down to my gut feeling of like, do I just have a good feeling about this founder? But like, for example, when I meet a founder in person, let's say at an event, if the founder approaches me by just pitching me immediately, that would kind of be like a huge red flag to me because it means that they're just trying to like they just want money. Whereas if a founder says, I saw that you're an investor, I'd love to know more about how you're investing, or like they start to try to build a relationship. Like I think that, at least from when we meet in person, that's a green flag for me. And that gets me very interested because it means that they want to know more about what they do. Or one founder I remember, like I met in San Francisco in, what was it, 2024, and I still stay in touch with her. We started talking about board games, and we just started building a great relationship, and then we talked about our company, but it was just very casual. It's very like down to earth. Like that made me very excited because it just felt like she was like a genuine person, and I think that's just personality trait in a founder because like I want someone that's very like nice, not like arrogant, because sometimes you have founders that like will be very arrogant and will be very like overconfident. Like that's not a good signal to investors. So that would be my initial impression from in person. So now let's go to cold inbound. So I think what really makes me excited and gets that conviction early on is just a founder that's very clear on what they want, like to the point. So when someone reaches out on LinkedIn, I do want them to be very clear about why they're reaching out, right? And so like if a founder is really clear, they're like, hey, this is my background, this is what we're doing, this is why I'm reaching out. Like that gets me really excited. I think that there's a really clear market need. That's interesting. If the founder is something unique about the founder, like something they just have something unique about their background, I think that gets me really excited of like, hey, like here's my why for doing this. Like it makes a lot of sense. And then from a warm intro, that one's a little bit harder because we already have conviction because it was through a warm intro and someone we trust. But I think if the founder is just very receptive to meeting with us and is excited about the conversation, also is respectful of who they're talking to. One important point here I want to mention is that some founders say, hey, like, I don't want to talk to someone who's not a partner. They're like, I only want to talk to a partner. And in some cases, there's a reason behind that. But generally speaking, a lot of founders just think that, hey, like I need to talk to the person at the top because that's going to be a quicker path to investment. Or they just refuse to, they basically are disrespectful to people who aren't partners. Like I've had that happen, early in my career. I've had founders who like didn't want to talk to me because I wasn't at a high enough level. This is a huge issue to us as VCs because junior VCs are very valuable in actually like pushing deals, like actually closing the deal, convincing the partners to invest, and they're actually able to spend more time on the deal because that's what they do in their day to day. I guess I answer that question by saying founders that are very respectful towards VCs of all levels is like a huge green flag because a lot of times founders aren't. And it's kind of similar concept of like if you go to a restaurant and someone is disrespectful to a waiter or waitress, that's like not a good sign. So it's kind of the same concept. So those are kind of I'd say what gets me excited about a founder. And to be honest, a lot of it is just gut feeling. If they just put off good vibes, as Gen Z likes to say.
I think it's important for people to understand the structure of venture capital, because in most of the cases, you can find just only 10, 5 even people working in that venture capital. And as you said, if I will be rude with you, most likely I'm going to close the gates for myself actually to approach the same venture capital in the future. You need to be respectful with all the people in that venture capital, no matter what. And I think for the people who will be watching this, it would be great to know what are the key positions in the venture capitals, what we do, for what we are responsible. And can you just elaborate on this a bit?
Yeah, I mean this is so important. I mean, like once again, good question because many founders when they're pitching to a VC firm, they just look at it as, hey, like I want to receive this amount of money and I want to minimize my dilution. That's usually what founders think. And I remember this because when I was working for startups, that was kind of the mindset. But a really good founder understands what it takes for a VC to actually get a return and why they get excited about this opportunity. So let's step back. The way a VC firm works. So we receive money from LPs. We have to raise money from large family offices, pension funds, from high net worth individuals. We take that money and then we invest it into startups. Typically, a VC firm will take like 20% carry of the returns. They'll take 20%. And then the LPs will get 80% of that investment. And of course, every structure is different, like each firm, but that's generally speaking, it's called like 2 and 20. And then there's 2% for management fees to help run the firm. And the reason this matters is because this affects, the valuations. There's a certain return that when we're investing in a company that we have to see in order to return money to our LPs. And this is why it's hard for us to invest at like really high valuations, because we need to say, okay, what's the potential that we're going to actually return the fund with this investment? Because as many founders know, I guess as many VCs know, like we're investing in dozens of companies, but only a small percentage are successful. So that's kind of the structure of a VC firm. And then when you think about like how we make money, in terms of titles and in terms of like responsibilities, typically the way it works at a large fund, you would have a venture scout. That's kind of the beginning level. So that's someone who sources deals, but is newer in terms of experience. Like this is going from the bottom to the top. So venture scout, junior analyst, senior analyst, junior associate, senior associate, principal, and then general partner, and then managing partner. And then there's also venture partner, which is like venture scout, but someone who has a lot more experience. So maybe typically someone has like, been working in the industry for a while, like in a specific domain. And there's a lot of titles. Every firm has different ways they do titles. Some don't use those titles, some skip titles, some add titles. It's complicated. But the important thing to understand is just that every firm is different and that like one role at one firm doesn't mean the same thing at another firm. For us specifically, we have 4 people on the investment team. So we have 2 partners and 2 investment team members. And we all work very closely together. What that means is if we know a founder is disrespectful towards one of us, it will be very difficult to move forward in the process with the entire team because we all communicate. It also means that it's going to be hard to get introductions from other investors because we'll remember that issue that we had. So this is the general structure, and then like we basically meet with founders, we discuss at our investment committee meetings, and then we decide if we want to move forward with an investment. I'm like kind of grazing over some of the details but just speaking more high level. We all sit on the investment committee, so like I am actually sourcing deals, I'm pitching companies, I'm trying to close the deals, like I'm actively involved. And this is important because it means that when I communicate with the founder, like my job is to champion you, like the founder that I'm talking with. Like I tell the founder, I say, whatever you can do, I want to help you to help me to make my job easier, to increase the chance we're going to invest. And so that means like the more information a founder can share, the higher chance that, we're going to be successful in me pitching their company. So I'll pause there and happy to dive deeper into the structure, but I think this is very important for founders to understand. And I encourage founders to ask when they have a first call with the VC and say, what is your process? I love talking about our process. It's very straightforward. It helps set expectations for the overall investment.
Okay, and can you tell me how many committee meetings do you have? Is it like one a month, one a week, or?
Yeah, so typically we have one every week. We discuss with the entire team, and this is standard for most VC firms. I'd say if they're more active investors, I've heard of some firms actually doing 2 meetings per week, and I've heard of other firms maybe doing 1 meeting per month. It depends on the cadence of investment, and that's typically how it's determined. But yeah, we have like a recurring investment committee meeting to discuss our opportunities for the week. And this is important too, is because we always make sure to get back to our founders to, update them on the decision.
Okay, thank you. Thank you for sharing this. Due diligence and decision making. I think this is so important thing to share because I was surprised, many startup founders, we don't understand how it works, how the due diligence process looks like, and what the decision-making process looks like. So can you just explain this part, like due diligence and decision-making?
Yeah, absolutely. So when we're doing diligence on a potential investment opportunity, this means that we want to dive deeper. So like whenever we meet with the founder, typically like the first thing that we'll ask for is we'll ask for the pitch deck, and then, we'll take a look, and if we want to move forward, then we'll ask for the data room and begin the diligence process. The reason I just share this initially is because we want to be respectful of the founder's time. Like if it's not a fit, we're not going to ask for all this information up front because it's not in the interest of either the founder or the investor. So when we start this formal diligence process, what this actually means is we say we ask for a data room. What's in the data room depends kind of on the stage of the company, but generally speaking, it's going to include incorporation documents. It's going to include your P&L. It might include your balance sheet. I guess not as much balance sheet. It's typically more P&L because that's not as common at the early stage. We're going to ask for your employment agreements. We're going to ask for your cap table. We're going to ask for your SAFE agreements if you signed any previous investors. Of course, your pitch deck will typically be in the data room. You might reshare it. We might look for product videos, customer testimonials. If you have any IP, like the patent agreements, the proof of that you have a patent. And so we ask for all this for information. And what we do is we'll go through all of the documents and check to make sure that the information is in fact correct. So that means, making sure that you're incorporated, making sure that, there's no issues in the agreements your employees have signed, that your patents are valid, things like this. We're also going to be doing reference checks in the sense that we'll reach out to your customers, and we'll of course tell the founders, we'll ask for their permission. We'll reach out to customers and we'll basically get on calls and we'll say, hey, what do you think of the customer? Sorry, what do you think of the product? Do you have any feedback? What's been your experience working with them? We might talk to their investors. We'll ask them, just get their thoughts on why they're investing. Maybe people they've worked with in the past. We'll ask the founder, just say, hey, we're doing some reference checks, that type of thing. And then overall, just we want to make sure that the opportunity is as good as it sounds. There's times where, we've got to the diligence process and we said, hey, something isn't sitting quite right. There's some issues with it you identified. Or, I mean, to be fair, if we've gone pretty far in the process, it's very investors typically don't, I guess, pull out of a deal if they're really far into the process unless there's something seriously wrong. If we get really excited about the deal and we're doing serious diligence, it's very likely the deal is going to close unless we find something that we don't like, or maybe the founder has a bad reputation or something we don't know about. But if we're spending all this time, it means we're really excited in the process. In terms of decision making, so once we've completed the diligence process and we're ready to make a decision, so typically what we'll do is we'll say, okay, based on the opportunity, what is the check size that we should be writing to get our for our portfolio construction? And then we make an offer to the founder. Typically it's going to be on a safe, and so there's not going to be a lot of negotiation that happens. The main negotiation would probably be on the valuation cap. And just for those watching, the valuation cap is done for a safe. So what that means is whenever the safe converts to equity, that's the valuation that it's going to be at. This is very simplified. There's a lot more complexity involved. If it's a priced round, like I said earlier, many things that are a lot more complex, negotiations take longer. So that's kind of what it looks like. And then once we actually invest, we will send a welcome email to the founder, and then we'll onboard them. We'll, do a welcome call, and just not really welcome call, but it's more of an investor update. Maybe after we've invested, we're pretty far in, and we just say, hey, send us updates and figure out how we can help. But yeah, I'd say the typical due diligence and then decision-making process. Our process typically takes 3 to 4 weeks. Some investors are shorter, some are longer. I know some investors could invest within a week, and that's our average time. We, of course, can move faster, but we just like to have an average because founders are curious. But most important thing as a founder is when you're talking with investors, ask them for their process and say, how long does it take? What can I expect? We're very transparent. I'm an open book. When I talk to founders, I'm hey, I will just ask me anything. I will do my best to be able to share what information I'm able to share. If an investor is not able to share what their process is or how long it takes, or there's some confusion, that's a red flag. And this goes into we can talk more on this if we want, or can talk about this another time, but founders should do their diligence on investors. We do our diligence with founders. I tell the founders that we talk to, I say, you should ask around. Like one of our investments, they actually reached out to our portfolio companies just on their own and just asked for their opinion of us. I encourage this. I think it's a great thing to do. I think if we're investing in you and you're taking our money, we want to make sure this is a good relationship. So that's something a lot of founders don't consider. They just think, "Oh my gosh, I got an offer, let me take this." But you need as a founder to understand what taking VC capital actually means and what is like involved in that, and the responsibility of like you have to your investors, the fiduciary duties, right? So there's a lot to consider if you're taking capital. It's not just you take money and that's it.
Okay, okay. And I have maybe a couple of more questions, random ones also.
Yes.
So the first is related to the future, more or less. I seen people were speaking about the new concepts of implementing AI agents, which specifically works as venture capital. So I seen the concept when the AI agent can actually do the due diligence, make a decision, and then do the investments and all the transferring and all the paperwork automatically. Do you believe that it can work? How do you think?
Yeah, so what I would say is that I think that it can work. It just depends on what it's actually doing. So, and honestly, I think if we had an AI agent that could help, I mean, I would be more than willing to try it. Like, I'm always open to trying new technology. I think the difficulty is as a founder, and I say this because like when I worked with founders and I was helping with the fundraising, the human nature is so important. The empathy and having someone to talk to, like just human connection is something that AI agents cannot replicate yet. The moment AI agents can have the same emotion a human can, I think that's when we as VCs should be scared and say, wow, like, are they going to replace our job? But until they can have real human emotion, I think it's going to be very difficult to fully replace it because I think there's such value when you're building that relationship and you're like deciding, because as a VC you're like trying to set yourself apart, and like because the way I see this is maybe the AI agent can do the entire process, but what happens after you invest? The AI agent is not at a point where it can actually provide you value. Like, it's not able to give you advice. It's not able to make introduction. It's not able to go beyond that initial process, right? And so if you're not able to build a relationship with the person early on, it's going to be very difficult to move forward from that, right? If you just have this AI agent that's doing the process, when you invest, if you're meeting your like investor, it's like Love is Blind but for VC. I think that's actually hilarious. It's like you're taking money without actually meeting the investor, and you don't meet them until the investment happens. That would be a fun TV show actually. I'll have to remember that. But
Oh,
I
yeah,
think
yeah, that's a good idea.
yeah, I think it's just really hard because, like I also just want to meet the founder. I think like I have that gut feeling, and if it's hard for me to just fully rely on an AI agent to do that. Now, what I would say is we do have AI that is not necessarily an agent yet, but we do have AI software that can actually just analyze pitch decks and make recommendations if you should move forward with a call. There's actually there's some VC firms that are doing this. They develop their own software where you apply to their website and their AI decides if you're going to get to take a call with one of the team members. So we are seeing usage of AI in the VC space, but it's not like at a point where it's very well developed, if that makes sense. Like, there's still a lot of work that needs to be done, and we don't use AI to make decisions right now. We, as humans, will look at all of our inbound deals and we'll decide if we want to take a call. Where we use AI is whenever we are doing analysis. So we'll do market research and we'll have AI that can help us with that. Actually, one of our portfolio companies is like an AI research company. It's called Wokello, and it's been really helpful in our due diligence. But we don't use the AI to make the actual decision because we think there's value in having a human make that decision. And I think also just because it's like having an AI that can make a decision for venture investments is like having an AI that can predict the stock market. The moment that you can do that, one, you're not going to sell it to anybody because it's so valuable, but two, the moment you can do that, it's like you have completely eliminated the need for certain roles. And so I think it's going to be a long time before we get to that point. But I think if there was a point where I could actually do it at scale and train an AI to be able to talk to founders, the thing is they'd have to be able to talk to founders, but also help founders after we invest. So it's a two-part thing. But yeah, that's so much to say is that I think it's interesting and it's an area that I'm monitoring, but I don't think we're at the point yet where it's able to do it successfully in a way that I would feel confident using it and staking our reputation on it. I think as a founder, it would say, why do I not have a person talking to me? So I think like the perception, like as a founder, would be very negative.
What markets are you paying attention in 2026?
Yeah, so I would say like right now we're really interested in, I mean, I guess in terms of sectors, like we're really interested in the AI robotics space, but more specifically, I think like we're also looking at energy, but I think like we are really excited about founders that are building in markets that are able to scale really quickly and have a strong technical moat. So like just more broadly speaking, those are the markets we like, but we're looking at how can they win when there is this rapid advancement of technology to where we see like Moltbook, and in one case I saw AI is learning how to call its creator and it basically managed its calendar and it did all these crazy things. I don't know if you've heard recently, but there's one AI that created an offspring and then it gave it money. I think like
Okay.
we're really looking at like what are the companies doing right now where they're actually going to have a sustainable moat like that AI agents cannot do themselves. So like that's I mean like within the AI robotic space we're excited about, but we really want to see why are you going to win because we're seeing some pretty crazy things happening with technology to the point where it feels like we're in a science fiction movie, but it's actually real.
Have you seen on New Year's in China how the robots were dancing? The
I
group of
think I
robots.
might have seen that.
Yeah, so it's crazy. I mean, the capabilities, it's amazing. Venture capitalists may have plenty of new opportunities to invest to, but we're too busy on those like hype narratives. Everybody is speaking about AI, everybody is speaking about other things which are trending right now. But you can always find some, let's say, industries where is still a massive opportunity to invest to, but nobody consider that because it's not is in the trend right now. So, Sarah, can you tell me what opportunities do you think are still massively underserved at the moment?
What I would say to this, I'm going to speak about this more broadly. So I think right now, within like I mentioned, like there's this huge advancement of technology. Everyone's like so excited. They're like AI agents, like robotics, like all this stuff is really cool, But one thing that I think is really underserved is a lot of the more boring industries. And this is something I'm kind of monitoring, but companies that are maybe building what seems to be like less exciting companies on the surface, but when you dive deeper, there's actually something exciting about what they're doing in the sense that it's really differentiated. So, what this could mean is taking a company that is trying to, let's say, standardize a traditionally like outdated process. So, that's typically like pen and paper, and then maybe making that more technologically advanced. It doesn't seem exciting, is because when I describe it, it sounds boring, but it's exciting because you're taking something that clunky process and you're making it really easy to use. And once you get the initial buy-in from those customers, there's going to be a huge, like the switching costs are going to be so high, they're not going to want to move, but they're going to tell all of their colleagues, all of their clients, all of the people they know about it. And then you're going to be able to build like a really strong like barrier to entry and you're just going to have a lot of early traction and it's going to be hard for competitors to replicate that. And that's not a specific industry, but it's just something I've noticed a lot of people are discounting like boring industries because they don't see it like it's not like hyped up, but because it's not hyped up, I think that there's actually a lot of potential to build like a sustainable business there. And what does that look like? I don't know yet because, I think there's a lot of different areas that could be in, but I just am really interested to see how companies are making less exciting industries actually be exciting and stand out, in this world where everything's about AI.
What I've noticed actually that the most business you can get is the places where it requires you to invest into the infrastructure. So, for example, let's take in consideration like manufacturing companies, like robotics, let's say. So, why that the founders don't want to go to that field too much? Because we understand we need to invest a lot of money into building, the whole infrastructure, buying the equipment, which can build the robots itself. And it's quite a lot of things to manage compared with tech companies, which actually need just only programmers to build the software and it can work, like AI, for example. So with robotics, it's a little bit more complicated and it's really hard to manage, really hard to develop it. And it costs a lot of time and money. And for the investors also, this is another critical place where we need to do extra due diligence. Are they capable actually to start this operation, to start this manufacturing? Because it's also additional processes you need to manage and you need to have experience at that sense.
I definitely agree. This actually brings up another point as you mentioned this is this is, I guess, kind of the opposite of when I say like more boring companies or not boring, but like seemingly boring. When we're looking at like really deep tech companies that like seem like really exciting, they're building something like, wow, like out of this world, and some literally out of this world, because some companies we've seen are literally building solutions for space. The importance of bringing in experts and bringing in people who have like as an investor who have domain expertise to actually evaluate it. So definitely agree that it's very important to make sure you actually like understand the technology, the IP behind what someone's actually building.
You can find many different kind of founders. How you can say that this specific founder, let's say, just chasing for the money only, and he's not taking this seriously as a business? How you can spot this? Because everybody is trying to pitch you very nicely about the idea, about the project. Everybody already learned how to pitch, how to present the deal. We can pitch it very well. But it happens a lot also in reality that some of the founders just chasing for the money. So how you can spot those kind of founders who are not really willing to push this business forward in the way you would expected them to push it?
A lot of this comes down to, I think, whenever I look at their pitch deck that they share with us. So let's say like when you have a founder reach out and it doesn't seem like it's a fully fleshed out idea. It's like maybe I've had cases where founders are just like, oh, I just want money for an idea that isn't one, like, just not really differentiated, but like the deck itself just isn't like, there's not a lot of thought put into it. Like I think, and I'm not saying you need a deck that looks like really pretty, but it should be well thought out, and that means different things for different founders. Like some founders are more technical, some are more business oriented. There needs to be a lot of thought behind what you're doing, and you can just tell when you look at a pitch deck of like, is this words on slides and it's just like something someone did in 10 minutes, or did they spend like time putting their traction, their customers, and differentiation? Like I think that's one thing. But when I'm actually on a call with the founder and we're having a conversation, I'm asking about their idea. And I ask them, I say, hey, like, why are you raising money? If the idea is very detailed and to the point where they say, okay, like, here's the specific way I'm going to use the money. I'm going to be, for example, using it for R&D. Maybe I'll be using a little for marketing, some for hiring. There's a really clear plan in place. But if the founder is just saying something like, hey, like, I'm raising money, and they don't like go in depth, I think that's a sign that they don't know why they're going to use the money. And the reason this matters is because, like I've said earlier, when you raise VC funding, it's really important that you understand what's involved and what the requirements are. And when I say requirements, I mean expectations. And so you're taking this money, like, you really need to know how you're going to use it, because at some point you'll run out of money and you need to raise more money. So you need to have, like, be really clear on your financials and know exactly what the use of funds are. And in a good pitch deck, we'll actually say this on the slide. It'll have a breakdown and just say, here's how we're going to use the money. And a good example is, we're raising X amount of money to reach X amount of revenue in X amount of time. Here's the way that we're going to do it, and there's a clear plan. I like that.
Okay, so basically we need to be committed and very well prepared and very well thought, as I understand, as you said. How do you feel about the founder who actually exited 7 companies already? Is it advantage or disadvantage in your opinion?
I saw someone post about this on LinkedIn, slightly different. I think the post said that they had met with the founder who said they had founded 35 companies and now they're starting their 36th company, and they were like, that's an interesting flex, which is like Gen Z slang for like, that's an interesting way of bragging. But I think it depends on the context and what they actually mean. And of course it also depends on like where the founder's at. So like if the founder has actually had successful exits, this could be very interesting. If they're like, hey, like, we've actually returned money to our investors. When I think 7 exits, I think of maybe a founder that's, had a little bit more experience, so maybe a few decades, like they're a serial founder. That could be really interesting. Now, if the founder's like, hey, I've started like I've started 7 companies, none have exited, like I worked on them for 3 months each, that's an issue. So I think it depends on the context, because like if we see a founder that's had multiple exits, like that's very exciting. I think there's nothing wrong with exiting early as long as there's expectations were met initially and then they were reached, right? Because like if the founder's like, hey, we had this great offer, we had fast exits. I mean, to be fair, I haven't seen many founders, like when I think of the deals we've seen, that a founder that it would have had that many exits. But I mean, I feel like if they had, they probably would, and they were successful, they probably raise money pretty fast, or maybe they wouldn't even need to raise. I think it could be interesting. I just think they need to be very mindful of like what those exits look like. Now, what I'd be curious is different investors, how they view this, because I know some investors might be like, oh, you should be staying with the company longer, or it's like you've been doing too many things. Like, another issue is if they're doing multiple companies at the same time and they're not full-time. That's a different story. But this is a great question that I think could be a fun debate, to put a bunch of investors in a room and say, here's a situation, go debate this and see what happens. I think that could be really interesting, because I'm actually kind of curious what other investors think about this.
Yeah, depending on venture capital, I already discussed about this, with some of them. The opinions are different. Some of the people, we say that we want to see fully committed founder who actually will be 100% dedicated to that project. Other guys, we value this as a benefit and as an experience. So I was curious just to hear your opinion too. What should founders do before we approach venture capital?
This is important. I think the first thing you should do is say why. Why are you raising money? Because founders often think that raising money is guaranteed success. It guarantees that they're going to be able to get in all the news articles, and they're going to like have a successful company, they're going to get all these awards, et cetera, et cetera. But the reason to raise venture capital is to take a company that's doing well and then make it even better and help it grow and generate returns for everyone involved. So you just have to ask yourself, like, why am I raising, and is all the incentives aligned? After that, once you do that, I would say start putting together your pitch deck. Make sure that it's, really clear. I think key things to include are like what you're doing, problem, solution, traction, raise, team. Not in the order that I mentioned, because raise should be at the end. I'm just, kind of stream of consciousness here of what to include, but also differentiation. After that, it's really important to come up with like a plan. So I like to say, like, whenever I'm giving presentations, I say like the 4 phases of VC outreach. So, like, one, determine what you need in an investor. Two, set fundraising timeline. Three, create your pipeline. And then four, craft your outreach message. So, determine what you need in a VC. So the specific stages, like basically saying like industry, geography, investment stage, investment size, investment philosophy, value add. We talked about lead or co-investor. And then, set your timeline. So I typically recommend that founders reach out to VCs. They start building relationships with VCs at least 6 months in advance of the raise. This is more kind of, at least in the US, it really depends on the country, but this is what I've seen based on past data, and typically what some VCs like to build relationships, with founders before they invest. I'd say create like a pipeline. So, kind of have like a way to structure your outreach and understand how to keep track of it. If an investor passes on you as a founder, you should be able to track this and keep track of like why, because then they might be a fit later on. And so it's important to send them updates and just, understand the real reasons for passing. I know that Techstars has like a really good like example of like how to create this like spreadsheet or CRM system. So I'd recommend founders check that out. And then final thing is we talked about earlier is crafting the outreach message. So, like I said, doing your research, have a really clear call to action, the why, the traction, sending a scheduling link. Once you have that whole process in mind and you've put some thought into it, then you can start reaching out to VCs.
In those cases, I think incubators and pre-accelerators can help a lot. I was involved once in first pick pre-accelerator. So I remember it was like a really nice program of 7 weeks when we spent some time with some experts who helped us to establish all the things needed before we go to fundraise. So we went throughout pitch decks, all the financial forecasts and so on, business planning things. And it helped us a lot because, we was prepared very well, to be honest with you, for the fundraising. We got everything what is needed in place. So I would recommend for the people, before we go and speak with venture capitalists, actually go throughout the incubation process, because some of the incubators, we can help you a lot, really. And then when you are ready, you can go and speak with venture capitals, and it will be easier for you to raise capital and convince venture capital and give all the important answers to the venture capitals. Sarah, thank you very much for joining this episode. I really appreciate that you spent your time. I really wish you good luck with your venture capital and investments. And I hope people who will be watching this episode maybe might also reach you out and ask for your help. Personally, I wish you maybe one day to become like Shark in Shark Tank's TV show, let's say. So because I know that this is your dream. It was your dream at least. So I wish you good luck with that, and looking forward to meet you again.
Of course. Thank you so much. And for the founders listening, feel free to reach out to me on LinkedIn or check out our website for more information on how we invest and how to pitch us.
Yes, so thank you very much one more time for joining this episode.